Hey guys, Joe here, back with another video. Today is Friday, June 25th, 2021, and today I wanted to cover writing covered calls on Excel Fleet. So let's define what a covered call is. A covered call refers to a financial transaction in which the investor selling call options owns an equivalent amount of the underlying security. To execute this, an investor holding a long position in an asset then sells call options on that same asset to generate an income stream. The investor's long position in the asset is the cover because it means the seller can deliver the shares if the buyer of the call option chooses to exercise. So put simply, covered calls means for every 100 shares you own for a company, you're able to sell one option contract against it. Now, because I own more than 100 shares of Excel Fleet, I'm able to write several option contracts against my position. As of now, I have 800 shares of Excel Fleet. That means I'm able to write 8 option contracts against my position. If we wanted a visual representation of what this looks like, this is what a covered call chart would look like. So on the x-axis here, you have your strike price. And on the y-axis, you would have your potential gain or loss, right? A covered call tends to be a neutral position. We're focusing on the potential profit, the call side. Realize that covered calls is a capped profit potential, meaning whatever your strike price is set at is what strike price you're willing to sell the shares for. For example, if Excel Fleet is at $8 today and I set my strike price to $10, that means at expiration date, the option will get assigned and I will let my shares go at $10 per share, right? Even if the price continues higher, let's say at a market price of $11 or $12, because you wrote the option contract at $10, you will be assigned at $10. That was the agreement. And obviously any option premium you generated from writing the contract, you get to keep regardless. Even if the shares are assigned or not, you always keep the option premium. So here are 2 more key takeaways. It is often employed by those who intend to hold the underlying stock for a long time, but does not expect an appreciable price increase in the near term. This strategy is ideal for an investor who believes the underlying price will not move much over the near term. So let's take a look at Excel Fleet within Yahoo Finance. If you haven't used Yahoo Finance before, it's a powerful all-in-one tool that gives you market analysis, trending news, how the markets are reacting, what's trending. I highly recommend it to anyone who's looking to investigate and do more research on a stock. So let's dive deeper into Excel here. And if we look at the 5-day chart, the price action here has been bullish last week, and we did hit a low of $7, and now we're currently at $8.71 as of close. With this modest run up, this is actually healthy for our option call because we actually gain more option premium the more the stock runs up. So as an option seller, this is a positive catalyst. And within the page here, you can actually look at some of the other technicals for Excel Fleet. Their market cap, earnings day, their earnings per share, the PE ratio, volume, their analyst ratings for looking at bullish, neutral, bearish, and then obviously headlines for the stock. So let's dive deeper into the options chain. Let's click on options tab here. And our nearest strike date is for July 16, which is about 3 weeks away. And notice Excel Fleet only has monthly expirations. So you're only able to execute option trades for 1 month expiration. Looking at the call section here, everything highlighted in blue is in the money. Everything below that not highlighted blue is out of the money. And if you were more bearish, you can actually look at the put section as well. So currently our price is at $8.71 for Excel Fleet, and I'm looking to place something near the money, close to at the money. So I'm looking at this $10 strike price. And so for this $10 strike price, writing an option contract, I will be able to net between 50 and 55 cents. That is the bid-ask spread between the two. And if we look at some other technicals here, volume today for Excel Fleet had 1,280 for this $10 strike price. Open interest, we have over 7,300. And lastly, implied volatility of 114%, which is pretty high. And if you don't know what implied volatility is a metric that measures the likelihood of changes in the underlying stock price. High implied volatility results in higher premiums. So what this means, within the past 30 days, if the price of the stock has moved drastically higher or lower or both, that means the implied volatility will continue to rise. And obviously, the further you go out of the money, you will earn less option premium. So for example, if you went to a $12 strike price, you would net between $20 to $30 per option. And $15 strike price, you would net between $5 to $10 per option contract. So I think $10 is a good middle ground here, and you can net between $50 to $55 per option contract. And again, the reason I'm choosing $10 is I'm neutral on the stock. I got in at a way lower price than the current price, so I'm happy at being assigned at a $10 strike price. So on the expiration date on July 16, there can be two potential outcomes. Outcome A would be XL Fleet closes below $10 and I get to keep all of my shares and I get to keep the option premium I collected. Or option B, XL Fleet closes above $10 and my shares are assigned, my shares are called away, yet I get to keep the option premium regardless. The way I see it, this is a win-win situation. I'm able to sell the shares at a profit and collect option premium along the way. So you can use this technique on any stock as long as you own 100 shares. So now I want to go ahead and show you how I executed the trade within Charles Schwab, and keep in mind you can do the same technique on any other brokerage app. That includes Robinhood, Webull, TD or Ameritrade, whichever one of your favorite apps you want to use. Open the Schwab app, select the Trade tab at the bottom, select Options, type in XL, set the strike price to $10, C for call, action sell to open, quantity 8 since I own 800 shares, order type limit so we can set the price. The bid and ask is between 50 and 55 cents and we want to collect the highest amount. But actually, looking at the last price here, the last price filled was at 52 cents. So let's go ahead and choose 50 so it can fill the order right away. Verify all the information looks correct. And our total amount earned will be $395 to 20 cents. Everything looks good. Place the order, submit. Great, and we got a notification the trade was executed at 52 cents. So Schwab gave us a better price adjustment. So most brokers will actually try to get you more money if they can execute it at a higher price for you, which is really cool. And just to verify, let's check our email, and we did get a fill at 52 cents, so our grand total earned was $416. I hope you enjoyed this content. If you have any questions, please leave a question in the comment section. I'll be happy to respond. Don't forget to like and subscribe. I'll see you on the next one.